Do you want to get rich from trading the markets? Well, two things. One, it's possible, but two, it is difficult because everything in life is difficult before it's easy. So there's a great saying in trading, it's simple but not easy. And the reason is because of the emotions, the thought process, the unconscious when you're winning and losing. So today I'm going to cover some key principles because if you're anything like me, when I first started trading 15 years ago, when I took a win, if it was significant, I got very euphoric. And when I took a loss, I was very down. And that was probably the hardest part and the hardest skill to learn is how to take a loss like a champion and really understanding probabilities and risk management, which is the true key to getting rich from trading the markets. So we're going to cover a lot of things in a lot of detail today. Get your math hat on, but I'm going to break it down in layman's terms so you can understand what it really takes to make a lot of money from the market. So if you like today's video, like, subscribe, hit the bell notification, and let's dive straight in. So the style of trading that I like to do is home run trading, knowing that some, maybe 10, 20% of your trades are going to be home runs, and you're going to make most of your money from 10 or 20% of your trades, which means the other 80% or so are going to be small wins, small losses, break-evens, and so on and so forth. So there's a key principle. And if you can log this into your mind, it will just change everything. How you feel emotionally when you're trading, when you're taking wins, when you're taking losses. Is to cut your losses short and do that fast and let your winners run. Again, knowing that you're going to make around 80, 90, maybe even 95% of your total capital from around 10 to 20% of your trades. So I'm going to break down a little detail today, a lot of detail today. We're going to keep it quite punchy. And if you want more information, I recommend that you download my book because I'm the award-winning author of The Extraordinary New Venture Capital Opportunity, How to Invest Like a Pro. It's free, link below. It'll just change your mindset, but it'll get you into my mailing list because we've got a lot of goodies, a lot of workshops, a lot of masterclasses, etc., to really ingrain a lot of this key principle. So let's get stuck in. So what you want to be doing is have a plan, and you want to plan your trades and trade your plan. So there's quite a few different strategies out there. So you probably got your own strategy, but you want to have it written out as a business plan. So here's a nice, simple concept when it comes to trading that I like to do is when I see a market move up and come back down, that's like a correction. If the market goes above this point over here, is likely to continue to the upside. And I want to make money on that upside. But I also want to protect myself from the downside. And that's what we're going to talk about, some key principles, but really how to think in terms of probabilities when you're really thinking about the markets. So let's just break this down. So over here is my trade expectation in this theory example. I want to enter the market above this swing high. So I believe if we break this swing high, we're likely to see the market continue to the upside. And I want to have my initial stop loss below this swing low. So if the market moves in my favor, I want to risk 2%, moves in my favor, triggers me in the trade. And at this point, I've risked 2% capital. So let's say we got 10 grand. We've risked 2%, which is $200 to find out if we're right. And if we're wrong, we can lose that $200. Now that's probably one of the hardest things that I found new individuals, because if you're like me, when I first started trading 15 years ago, I found it difficult. Taking a loss, I'm risking capital. I want more security, more safety, more predictability. But that's just not in the game of trading. We're here to manage risk and play the game of statistics. So let's just look at this. So I want to break some principles down. So at this stage of the trade, we've put in an order, we've been triggered into the trade, and we've got 2% capital at risk. So if the market now does this, we get stopped out and we lose 2% of the account. That's just a part of the business of trading. So what we're going to talk about next is risk management. Can we reduce this risk based on logic and be able to do it in a repeatable fashion going forward? That's going to be absolutely key. And that's what I mean by having a plan. Have a trade plan and then trade your plan. Make sense? So with this, I like something called a pattern reversal signal. When you've got an impulsive trend moving to the upside, I ask myself the question, what should the market not do? And that's where my stop loss goes. So initially, if this trend is to continue up, we got this swing low, the market shouldn't go below this point. And if it does, I want to be out of the trade, right? That's how we use stop loss. It's our insurance policy. But once we're triggered into the trade, I then ask myself another question. At this point, what should the market not do? And if it does do that thing, I want to be out of the trade. Well, a cool thing, if you know this, in terms of buying and selling psychology, is that the market shouldn't overlap into the former wave structure. I like this strategy. It means I get out of the market fast and I reduce my risk very, very fast as well. So how you do this, and again, you can have your own strategy. Really, the principle is reducing risk based on logic, is we move our stop loss to a logical point where the market shouldn't go back into the overlapping wave structure. If it does, we get stopped out and we have a break even or we take a small loss. So now what we've done effectively is reduced our initial risk from 2% to, let's just call it 0.2%. It might be 0.1%, it might be 0.4%, but basically we've reduced our risk by 80, 90%. So that means if the trade does take off, we make some really good money. But if the trade goes against us, we just take a small loss. We just take a small loss. If the trade goes against us, take a small loss, and then we reevaluate the market. So now I just want to talk about risk reward because we're going to break down some numbers today. So here's our initial risk. We call this the 1x risk. And our potential reward on the upside, if the trend takes off, in this particular example, is a 3-to-1 risk reward. In other words, if the trade takes off and we successfully ride that trend, we make 3 times what we initially risked. So in other words, we make 6% by risking initially 2%. But the key factor here that I want to get across is that we've reduced our risk to 0.2% to make 6%. So now I'm going to play some numbers out, right? We're going to play some numbers, and because what I've realized, I'm a mathematician, right? I got a degree in mathematics. I'm a former math teacher. I used to teach math, qualified to teach up to A level. So I love numbers because it cuts through the noise. But what I found is a lot of individuals, possibly you might be one of them, don't like numbers. So we need to keep the numbers very simple. So we don't need complicated calculus and rocket science math. We just need basic probabilities. And that's what we're going to look at next. So again, high level, if we're losing 0.2%, but we're winning 6%, we can actually afford to be wrong more than 9 times out of 10 and be right 1 time out of 10 and still make money from the market. So what's the expectations? Well, even if we were not getting success and we're hitting 90% losing trades and 10% winning trades, but the 10% was a 3x, well, all of a sudden the results are going to be quite positive. So let's look at some of the numbers. So I've actually built a trade simulator. It's a simple spreadsheet. I call it simple. It's not that simple, but it's simple that I'm going to cover it with you here. So I've just pulled it up here. What we're going to cover is what we spoke about. I'm going to cover 3 examples with you. The first example is a pretty not that great win rate, which is 1 out of 10 win rate and 9 out of 10 losing rate. And what this simulator does is it's a random number generator. It says we're going to risk 2% per trade. Randomly, 1 out of 10 is going to be a loss, and then the other 9 out of 10 is going to be a win. And what we're going to be able to see is how that performs as a portfolio if every trade was random. Now, again, another thing you want to get into your mind is every outcome of a trade that you place is independent from any former event. In other words, we don't know the outcome. Well, the only thing we as traders have control over is identifying an edge and placing that trade once that edge is in place, controlling our risk, like risking 2% of our capital, of our entire account size, 2%, and then managing that risk. Some, maybe 10, 20, 30% are going to be big winners. Remember the home runs, but 40, 50, 60, maybe 70% are going to be break evens, small losses, full 2% loss, or small wins. And that's what we're going to play with some numbers here so you can kind of get a realistic expectation. And again, remember, in the world of normal finance, hitting 7% plus in a year is good. If you manage to achieve 20% return on your capital trading year on year, you are amongst the world's elite. And if you're hitting 40%, 50%, 100%, 150% in a year, that is just on another level, right? And that's one of the other things, is just having realistic expectations and then doing compounding for the long term. And by the way, we're going to cover a bit of detail, but if you want to get into my private groups, my Telegram groups, my workshops, and we've got a lot of goodies. Just for now, download my book for free. It's a massive value in here. It's in the link below, and you'll just get onto my mailing list, and then there'll be some goodies that we'll share with you, including private Telegram groups and so on and so forth. So this is the first example that we're going to go over in a bit of detail. Then I'm going to jump into a second tab. The only difference here is the win-loss rate. We can do an example where we have 3 out of 10 trades being winners, one of them randomly being a 1x, so we make a 2% return. Here it will be a 2x, which will be a 4% return, and here will be a 3x, which is a 6% return, and keeping the losses at 0 minus 0.2%, right? And again, we're going to go over some numbers. I'll have a graph. I'm going to play it out for you as well. So hopefully it'll make some sense, or hopefully it'll make a lot of sense. And then last but not least, the real strategy that I play with is, and again, we don't know when it's going to be, is knowing that we're going to have some winners. Let's say it's 2 out of 10, but they're going to be small wins, like 1x's and 2x's. But 1 out of 10 or so, might be higher, might be lower, is going to be a big win, right? So we're looking at a 10 times risk reward, 1 out of 10. They're going to come, but they're not going to be that frequent. So we need to take every edge that comes our way, and we might have 20 trades before we get our first big win. And that's just the name of the game. We're going to have some draws, which means break even, like you risk 2% and you end up losing 0. And then we're going to minimize our risk as well. So now let's just go through that. I'm just going to show you how we're going to just do this last part of this risk management education. Because on the right hand side, I've basically just put a graph. So it makes it very visible for us to see. And I've just summarized the key information. And the key information is really the return on investment after 100 trades. So let's just go to the first example first of all. Let's go back over here. Again, this is the real conservative strategy. 1 out of 10 wins. So what I'm going to do, I'm just going to do a couple of random, literally just randomly picks out the numbers because every trade is random. So this particular 100 trades would be 17% return on investment, 41%. And you'll notice, and this is the reality of trading, and you just have to get comfortable with this, is a streak of losses, nice win rate, streak of losses, nice win rate, and streak of losses. Now remember, with this example, hopefully you're still with me, it's really looking at 1 out of 10 win rate, right? So this is, even if you got to this level, 25% in a year, 25%, 33%, 41%. But the thing I'm really trying to get across to you is not to just expect that. It's this, and then there's a surge, and then some drawdowns, and then a surge, and so on and so forth. So now let's go to scenario number 2. Scenario number 2, this is with a 3 out of 10 win rate, a 1x, 2x, and a 3x, with the losses 7 out of 10. And again, let's just go back to a graph setting. And again, what I want you to pay attention to, we're starting account size 10 grand. So these are the net return on investment. This is the gross account size after 100 trades. And this is the number as a percentage. So let's just draw upon some numbers and let's just see what kind of numbers this edge would play out, right? So 125%, 215%, 165%, 166%, 72%, and so on and so forth. Now the key is, and the real secret, because there is no real secret really, it's understanding that it's a random game, but we're looking to get predictable results. How do we get predictable results? By having a strong edge and then playing that edge time and time again. Now let's just finish on the last example. This is my favorite. We could go in a few other examples as well, but here we're keeping 2 out of the 10 wins very conservative as 1x, 1 as a home run, a 10x. It might be more, might be less, but it's basically saying when we hit a trend, we're going to compound the heck out of it and ride that win as much and squeeze as much profit as we can, keeping our losses very, very low. And let's just see how this plays out. And again, these are theory numbers, but again, it just really gives you a feel for what the market can produce for you. So again, 635%. So we're looking at this number over here. We got, let's just do 10 examples. We got 427%, 281%. And you'll notice, and look at this, right? A real long period of no growth. A lot of work, but no growth. And then suddenly we hit a winning streak. And that's just the name of the game, and you want to be comfortable with that as well. So let's do a few more examples. Let's do actually 5 more. So 293%, 874%, 147%, 732%. Again, we want to take this into account. A really slow start, even though it would have been like 20, 30%. But then we just hit a winning streak, and then really starts to compound on the tail end. So hopefully you found that really, really helpful, because I want to get across to you and just take your trading to the next level, because I've been trading 15 years and it's not easy. It gets easier with time, but emotions and probabilities are one of the most difficult things. So do download my book for free, and you'll just get onto my inside circle and we'll share some more things with you. But let's finish today on a quote. We're going to go with chapter number 8. I start every chapter with a quote. It's Henry Ford, and he said the following: "It has been my observation that most people get ahead during the time that others waste."